So with the resurgence of Delta variant, there are people who are saying that this risk may spark a market correction. Given the record rally on pause, this is a video done last July 8th. Let's watch and listen.
Watch. Our next guest is bracing for a major pullback, and he sees the Delta variant playing a big role in it. Julian Emanuel is BTIG's chief equity and derivatives strategist. It looks like maybe Julian himself is also at home, but working. Julian, great to have you with us. Thank you. How big of an impact is Delta variant to your view of the market?
So I think if you think of it this way, Melissa, from our point of view, the market has shrugged off virtually all potential negatives. And here we are. Essentially, we all know that the last several days have had the highest degree of mobility, certainly in the United States, since the pandemic began. And what we've seen after spikes in mobility has tended to be spikes in the virus. So if you combine that with this idea that Japan is going to stage the Olympics later this month, and what's really important is the potential reopening of the labor market in September when kids go back to school, and at the same time that supplemental unemployment insurance runs out, you have a number of events that, in our view, the market is pricing very favorably and really doesn't account for any potential upticks in the virus that could sort of upset the apple cart of the series of events that we're about to have in front of us.
We started the show with a question, Julian, and that is what does the 10-year yield lowest level since February or so tell you? And couple this with, of course, markets sitting pretty much at record highs across the board. What do you think the message is?
The messages are somewhat mixed. And actually, if you think about it, that is consistent with a market that, in our view, is likely to take a pause within the context of a market that, looking at a year or two from now, is likely to be substantially higher than where it is. And so if you go back to when yields topped at the end of March at around 175, what we saw was strong buying by international investors into U.S. fixed income, essentially, in our view, because those are the type of people who really haven't seen the end of the virus crisis to the extent that we have. Obviously, vaccination has been very good in the U.S. And what we've had was, in the wake of the Fed's announcement at the last meeting, the expectation that there might be a taper, which sent the yield curve flatter, sent 10-year yields lower, which obviously haven't recovered from there. The combination of that and the fact that, again, we do have a potential headwind with regard to public.
So what we're getting out of all these strategies are the following things. They're looking at inflation. They're looking at higher interest rates. They're looking at the U.S. tapering the bond purchases, which was announced by Jerome Powell. They're also looking at the potential risk of Delta variant with the reopening of school and offices this September 2021. So they're pricing in that the market is fully reopening with perfection, and as if the risks of any Delta virus was absent. Also, you are seeing people talk about tech bubble 2.0. The price to sales ratio that was published by Morgan Stanley Wealth Management just recently warned clients that there is an increasing probability of a big stock market correction. This Lisa Shalit published a note saying that the clients have to be aware that the valuations today of tech stocks are bubbly like 1999. She's referring to the Nasdaq bubble since 1999. She was saying as well that many of tech investing fanatics have been saying the current bull run is nothing like the dot-com mania because of massive earnings and disruptive innovation behind it. But we have to admit, we are starting to be getting extended in that technology and disruptive innovation narrative. Narrative with numbers, yes, but it's still, it's been what? More than 100% already for the Nasdaq itself. So more than, actually, it's 6,000 to 15,000 in Nasdaq to be exact. So the S&P index is now also exceeding 3 times price to sales ratio when the dot-com bubble high was just under 2.5 times. So you could see here that in the 1999 levels, this was the S&P 500 Information Technology Index, Obviously, right now, the information technology index of S&P is more stronger with validation, but the valuations are still very toppish. So this was the view of Morgan Stanley's CIO. I'm going to share to you other analysts. For Harry Dent, he's a perma bear, just be careful. But he is also saying and repeatedly saying nowadays, the rare convergence of long-term cycles bottoming out. There is a 90-year super bubble or a great reset bottom. It happened 1932, 1842. And so he's thinking 2022 or next year. 80-year end of winter season. There's a 40-year generation or spending wave bottom. There's a 20-year half generation cycle. And of course, a 10-year boom bust cycle. The first 3 years every decade, year 2000 to 2002, 1990 to 1992, 1980 to 1882. And so he's saying that by 2020 to 2022, you will get some super crashes. And he's saying, of course, that the quantitative easing creates markets on a crack. We're 120% overvalued this February 2021 when we actually peaked, and we still have barely broke above that. So that is actually a sign of a bubble that is the top, and any rallies are just lower highs. And this fictitious rally in the S&P 500 and Nasdaq should be exited. He didn't say short, but he did warn of a potential crash. He is, of course, saying that a crash reality or become Japan in his Zoom meeting, which I listened to. He was saying, Harry Dent was saying, global real estate, debt securities equals fixed income. Equities, gold, even cryptocurrencies are actually inflated with $525 trillion in his estimates. And in his view, in the next 5 years, if that was what the valuations were, it should deflate to about half, at least 50% drop. So he's predicting basically a demise, a whole move, even equities of an 80-70% crash, real estate to crash 40%, fixed income to crash 30%. And the only thing that he's looking to hide into was treasuries. So basically, he's just thinking of parking there. Now, also, when we take a look at the Twitter pulse, people are also seeing the same thing. A lot of the sectors in the stock market are actually rough right now. If you take a look at the broad market, people are selling out of growth. They also ran out of crypto, and now they're flooding into the trusty technology, which is your FAMGAS. But what happens when tech finally takes a breather and profit taking? There's nowhere to go. The final peg holding the market up will go away. So the reopening trade has stalled out. Small cap is a disaster and crashing. SPACs are not viable. Crypto cannot hold the heat. Just about every Chinese stock has massive hesitation. Value has stalled. The only thing holding the index up is technology. It seems super sketchy and dangerous. Inflation is real, 4 or 5% for the next 4 years. Virus has the market on eggshells again. Hate to come with all these bearish comments, but it's hard to vision a strong bull case unless a reset comes in. Seems like we are stuck in no man's land, living out the rest of the days trying to stay green with just technology, a very narrow green. So the last observation here is, of course, meme stocks are now diving hard, which is bad news. The fact that retail cannot actually hold up their GMEs and AMCs or their wish tells me that the retail is losing the fight. The story is over, and now volume will die across the board. Retail is going to be turned off at this point. Margin call, diamond hands will turn into liquidated losses. With margin calls, very low volume, a hint of profit taking on technology, mix in inflation and the virus Delta variant, it just seems to be a bad ending to a movie we can see coming. I couldn't have said it better. And so when I read it, I would agree. Origami hands and paper hands, it doesn't have to be diamond hands forever. Let's take a look on the Nasdaq. Your Nasdaq looks to have a first target here of 14,600 and a second target of 14,200. We have extended all the way to 15,000 because of a flight to safety on a very narrow field, which are your FAMGAS. Take note that during March, when the market sold off during the first time, when the February peak and March sold off, the market fought for safety on the FAM gas. Here's your Apple rising from about 120 to as high as 135. Had a correction when the small caps were growing during May to June. One of the best times that Awesome 10X picks went up 100% and above. And then take a look again. Starting June and July, Apple is breaking above 20% from 125 to 150 and continuing further, perhaps 160. This, however, is not a sign of bullishness. This is a sign of flight to safety. Same as what's happening with Microsoft, same as this breakout on Amazon recently. Same as the continuation move of Google and Facebook, which are initially digital advertising reopening plays and then eventually applied to safety trade. You are seeing, of course, your growth stock Tesla actually just consolidating the entire February until July. From about February, March, April, May, June, July, it never broke above your February highs of 900. It couldn't even break 720, which tells us that Tesla as a growth stock of ARK Invest is having a hard time breaking out. There is a potential for it to retest as low as $600 or $570 here. Now, Adobe also flight to quality. Take note that these are all flight to quality plays, but even NVIDIA is trying to sell off already after a rally from 550 all the way to 800, which was initially, in my view, a flight to safety play because of artificial intelligence and cloud computing and 5G benefiting one company dominated by NVIDIA. Now, ASML, Semiconductor, you could see that from March till July, the market made a money rotation flow on Semiconductor, and the semiconductor stocks went up, just as you can see here. However, after a 40% rally from $500 to $700, look at it, it's also taking a breather. NVIDIA down 4% in a day, actually down 10% already in the last week. ASML falling in the last 2 days. PayPal getting a double top here at $300 despite very good numbers. Comcast multiple top cannot break out above this $58, suggesting valuations are really the difficult barrier here. So although Apple can rise from $148 to $160, that is not out of the question. We do think that this run up is quite extended. Now, if you're wondering why is there a $160 target, it's because this entire rally from 110 to 140 is a $30 range. And usually you get the same type of length if this was a 12-month breakout from 138. So usually in the next 12 months, what you're seeing here is an overpricing of Apple for the next 12 months. So usually like this one, when it rallied, it will consolidate. And we are seeing that Apple would probably, in our view, if we're going to guess a top, it will be somewhere here after the breakout of 140. So at least $20 to $30 higher or 160 to 170. So technically speaking, Apple can still rise another 10%, neglecting the 10% correction that many strategists are saying. However, even if it does go up, it actually shows you that it's a flight to safety rather than a bullish move. Amazon, it's still, as you could see, just like Apple, it slept for about 12 months and it became a breakout on the eve of the market actually selling off. So it's actually breaking out as a flight to quality again. So we are seeing this correction happen. It's true though that selling the Nasdaq is very dangerous because the Nasdaq is 50-60% composed of these top 20 names. And therefore, you couldn't actually see an extended sell-off on the Nasdaq simply because we don't see an extended sell-off on your Apple and Amazon. Any dips of Apple here about 3.5 will always have a buyer, just like how Amazon always had a buyer here at 2.9 for the last 12 months. So usually after a successful breakout of Apple and Amazon, the prior resistance here is becoming the first sign of support. Now let's take a look on Microsoft extending. Now 280 can indeed go 300, but take note, these movements for the last 12 months of Microsoft is something of an exaggeration yet again. From about 185 to about 285 nowadays, it's nearing more than 50%, which is already, we're talking about $2 trillion. So, yeah, That's just how valuations today are for even our top mega caps. Take a look at Alphabet, also rising to 2625. By whatever measure, you couldn't actually argue that they are not going to dominate their respective fields. However, with big tech, actually with a potential risk of overvaluation and taxes in the future, I'd say that it's better to be cautious rather than being very aggressive. While it is very near their upper end resistance, it is not really a case to just be complacent. Visa, you could see that strong run up. These are all, especially when it's surging like that, the movements here is similar to what happened during March when there was a huge move on Visa. Usually this applied to quality play. 210 all the way to 240. Another breakout from 240 could rally to 270. But when people are running away from something, it's really because they're afraid of the entire market selling off. Gold is rising as well this part of July. So you're seeing that no matter if the dollar is expected to increase in rates, the market is actually seeing things like these as hedges. Or they're actually positioning themselves to still own commodities. Take note too that even with the mega caps, there are already cracks happening. Taiwan Semiconductor, $100 billion company, shares are tumbling as margins are concerning, outweighing the strong demand. After earnings, Taiwan Semiconductor shares are dropping the most in the last 2 months. Their gross margins are disappointing investors who banked on them to benefit from the ongoing chip shortage. Stock fell 4% in Taipei trading, snapping 4 days of gains. Gross margin is going to be below 50%. And also, the Taiwanese dollar is a problem, the dollar exchange. So for the September quarter, the gross margin is going to be less than 50%, and the quarter guidance is also a disappointment. So although 2022 and 2023, the gross margin could even fall further, the company doesn't seem to represent any pricing power. So simply indicated, Moore's Law is just getting too expensive, while TSMC will have to suffer margin erosion to keep the chip scaling trend going. So TSMC is, of course, a beneficiary of iPhones, smartphones, all of your semiconductors. However, with outsized expectation and excessive valuations, any imperfection is going to cripple the stock. Take note, Taiwan Semiconductor already rose from $40 to $140, or nearing times 3. And this could actually weigh the sentiment of the market as well as your Nasdaq. So from $130, $125, we're seeing this to fall at least nearing 100 or 25% down. So let's take a look. This is July 16. These are your 52-week highs. While there is no suggested drop yet from the 52-week highs, you're still seeing Facebook just down 4%, Amazon just down 4%, Apple just down 1% from its all-time highs. Your Microsoft is just down 1%. Your Nvidia is just down 9% from its all-time high. Google is barely unscathed. This is just down 1%. Comcast is just down 1%. Intel down 20%. Tesla down 28%. Now, Chinese stocks really hemorrhaging, of course. But as you could see, in general, the US stocks are still less than 10% away, suggesting the froth is actually there in the market, especially Nasdaq. Now, on March 14, 2021, we had a free Friday class just like this one, wherein we said why we want to nuke. Pigs get slaughtered. We talked about solars, cannabis, SPACs, crypto-related stocks, biotech, space, digital advertising, wearables, additive manufacturing, and to a certain extent, even if e-commerce, cybersecurity, and gaming are relatively strong, we still cannot be complacent. Similar to the FAMGAs, they are strong, but cannot be complacent about it. We have the following short ideas for you today. And I'm going to say that the space is getting really frothy, with ASTS and Astra and GSAT being given shorts. SaaS names were giving shorts on Okta, Zscaler, Twilio. Hot IPOs like Sentinel, which is a cybersecurity that is overpriced. Growth names such as your Cathy Wood names. Roku, your solar names like Jinko Solar and Enphase. Some e-commerce names like Etsy. Some fintech names like Square. Digital advertising names like TTD, The Trade Desk. DocuSign, which is a SaaS favorite, Spotify, a streaming favorite, some biotech names like Intelia, even after a successful gene editing breakthrough, Editas and CRISPR, which rallied on behalf of that Intelia news, some Chinese EVs, whether that be NIO, XPeng, Li Auto, Arcimoto, and even some of your agricultural names, your cannabis name in their farming, Agrify, some buy now, pay later fintech firms like Affirm to continually perhaps trade at lower lows. And fastly, to have a difficulty in the next coming earnings front, Peloton to also have difficulty in the next coming earnings front. Double tops and bearish engulfing could be seen even on the likes of some strong e-commerce names like Shopify, The Trade Desk, and DocuSign. Some bearish engulfing is seen on Upwork and Fiverr. We'll discuss these freelance platforms as well. So solar sector has been getting creamed. Chinese sector underperforming on regulatory concerns. And your space, additive manufacturing, falling southwards as we thought. This is happening last night, and we continue to see these reds to actually dominate for the next few days and weeks. So the February highs have not been pierced. That is obviously a sign of weakness, and that could be a resistance for years. Weak stocks have weak sectors. So a few things to note, IGV, if you take a look on IGV, this is an ETF, an exchange-traded fund, on all of your top software names and tech names, whether that be Adobe, Microsoft, Salesforce, Oracle, Intuit, ServiceNow, Zoom Video, Activision, great mega caps, yes. And these look actually toppish. Take note, Adobe having a toppish sign, Activision barely breaking out, still consolidating, Salesforce still below those March and February highs. ServiceNow cannot break the consolidation. Although Microsoft and Intuit are very strong, it must be taken into consideration that these names can actually falter soon. And when they do, profit taking will spell a doomsday on your Nasdaq. Oracle is still strong. Zoom, of course, been falling down since October. Why October? It's because we got the Pfizer vaccine and BioNTech and Moderna around October, November. So that was the height of the peak for Zoom. And take note what's happening here. Expanded tech software ETF, we're actually hitting that $400. This was brought about to all-time highs specifically because of Intuit, Adobe, and Microsoft. If those names are not going to go up, take note that these could fall all the way to about 360 or even 330, similar to May. So perhaps this one is stronger because we don't expect Microsoft to really fall back to about $200 below. But then again, at 390, it could fall 360, still a higher low. If you're looking on the long-term path, there's no reason to be upset. But of course, in the short term, we're talking about the short term, a 10% correction is not off the table. Invesco Solar ETF, solars have been very much the climate change darling. You could see that they're actually pulling back, and quite significantly, the pullbacks are actually as much as 50%, 44% on the ETF. Sorry, wait, let me, I'm afraid that my charging, okay, I'm just afraid that the charging could be gone. There. Okay, so solars in general have peaked because they went up very strong. If you'll notice, just like Tesla peaked, it seems like the poster child for climate change is Tesla and Enphase and SolarEdge. And all of these solar names have peaked in February and haven't actually broken above their March highs when we actually call the nuke. So these lower highs are going to persist as the resistances for the next 6 to 12 months, which means that your solar ETF have leeway to fall again back in May to retest that. If it doesn't retest this $67, good for us. But I think just for caution, be careful on these names because these have the potential to really to have a nasty sell-off. Weak sectors, weak stocks. Renaissance IPO ETF, also take note, since the February highs, we haven't seen any of the IPOs actually break above. While there were a few names that went up in the IPO sector, they haven't really broken above. Airbnb failed to break 200. It never even broke $170. Kupang never broke above $40. After $45, I think it broke down yet again. Your Coinbase never breaking above $400, never even broke $300. Many IPOs in general are getting a huge rally on the first week and then flopping 50 to 60% down, just like what happened with the firm, just like what happened with Sentinel One nowadays, and it's happening right now with Roblox as well. So why is there a drop in most of these companies? It's because of the frothy valuation. So if you'll ask me what would happen with Canva or Stripe, I think those IPOs will be an exit format, and it will actually be a doomsday for the retail investors who would ever touch those names, even if those names are very good names. Why are they doomsday? Because they're priced to perfection. And that's what's happening right now as well with Oatly. So the valuations are the concern here. And you could see that the IPOs are actually spelling doomsday, could go down 10%. This is the small cap Russell 2000. This is actually representative of the small 2000 companies that are present in the Russell. We're talking about the small caps. We're talking about the likes of Bionanogenomics or the likes of Nano Dimension. Take note that the Russell 2000 here never really broke above any all-time highs. It's always been stuck in a range from 210 to 234. What happens if we break down just like me? Usually the weak sectors will go all-time lows already. So the fact that this is presenting us a consolidation weakness, a choppy market, tells us that if you're trading these growth stocks, it's good because they always have a range. You buy when they're extremely oversold, but you sell when they're extremely overbought. And that's what's been happening with the entire Russell 2000. It's just been choppy markets. So what about your cannabis? Your cannabis names went up in the fast and furious way after, of course, October, November, when the Biden-Harris-Kamala tandem won, because they were legalizing marijuana, and true enough, there has become a sell on good news that happened. So recently, there's already a Congress passage of the bills of more acts. Apple added the store guidelines, Amazon also supporting it. However, even with those presence of good news, even with the presence of mergers and consolidation within the sector, we are seeing the general cannabis names. This is MJ, marijuana, alternative harvest, almost all the cannabis, whether it be recreational, medical, are suffering a drop. Now, you could argue that this $18 is still significantly above $10, which means that still, when we're talking about the likes of Tilray, it bottomed around $4 to $5 around September. Right now, Tilray is trading at about $14, $15, $13, still significantly high. I don't see it actually going down to September or November lows. However, when we saw these lows around May broke down, it's possible that the market might even see a bottoming out process of still 10 to 20% lower. So if you have cannabis names, I'm not trying to interpret that they will fall because they're already down. However, the problem here is that as of 2021, the cannabis names as a sector is still significantly 20% above your 2021 year to date. Now, primary, your cybersecurity names, we're talking about CrowdStrike, Palo Alto Network, very strong. You could see that this long-term uptrend still remains, and their fundamentals and growth is really there. So they've been the ones doing triple-digit moves in terms of fundamentals and aligning with the technicals as well. Sentinel One getting valued at more than at least more than $10 billion valuation, tells you that even an early entrant, I think like Sentinel One is just 5 years so far, is able to tackle a huge premium in the market. Tells you that this is a sector that the money is rotating into, just like the FAMGAS. This is where they're hiding. This is a safety place. However, at $60, I wouldn't enter this ETF. It means that in general, all the cybersecurity names still have a better entry around May to about 53, or wait 10% drop at the very least. So semiconductor, this is where people hid because your NVIDIAs, your ASMLs, your ACMRs, your AMDs, this is where everyone is hiding into. because they can see the perennial growth of cloud computing and artificial intelligence. You will continue to have many smartphones, many smart computing power data centers. So with all of that mobile computing devices, we are seeing semiconductor continuous to their strength. Now, this is from 1,600 to 3,200. Notice though that despite that super strength of the semiconductor, they're also having a tough time to all-time highs. So with Nvidia falling down, I think there's a possibility that this sector is just going to breathe for the next 12 months. It's just going to do what Apple and Amazon did, which happened July 2020 until July 2021, a slumber party, a sleeping beauty. So notice what's been happening in the TAN sector ETF. First solar topping out, nearing $95, now falling 85 quickly. With that huge drop, any rally is going to be a sell. And those who didn't sell will continue to see this go down to 80 or 77 or even 67. With downside bigger than any upside, this tells you that we are in a selling market. We are not in a buying the dip market. Take note, Hire Car, this is part of the electric related names. Hire is helping the likes of Arcimoto for the leasing of electric vehicles for the last mile delivery world and the freelance economy world. Take note that $24 slipping fast to 18, rallies to 22, and then slipping down to 16. This huge drop in the last 2 days is a cause of concern, especially after this rally from $4. So from 4 to 24, I wouldn't be scared to say that this could go as low as 13 or even at $8 yet again. Be careful with these names. Avalara, people who wants to have their tax computing easy and easily done, similar to Shopify, has been well loved by people as an essential of every entrepreneur who wants to do their own taxes. Might as well make it online taxes. Now, Avalara does that for so many entrepreneurs, so many people. However, you could see that the valuations are the reason why this is peaking and lower highs. From 185, 165, these lower highs and lower moves suggest a rally to be faded and actually to sell all the way to about 120, a sell-off to ensue in Avalara. Alarm.com is actually helping home security, and I'm seeing that these companies are dropping like flies, $100 to $80. Elastic, which is a strong name in terms of software application, is also falling down. Lower highs, 170, 150. Sharp drops here tells me a drop of about $100 is imminent, just like what happened in May. Celsius, a very strong name. Yes, Monster Beverage Drinks, something like that. But this is having a tough time. After a breakout to $80, we're seeing these highly valued names suffer from their own growth as well. High growth names are suffering, 80, 72. We saw this happen with Digital Turbine, despite different names, different sectors. But high growth names, highly valued companies are very much prone to falling from their own success. So their success is now becoming their wedge. StoneCo, you could see that fintech as a sector is strong, but not really as strong. StoneCo can't barely make above 70, falling fast now to $58, even in a cashless world. This is the Square of Brazil. Upwork, as you could see, double tops here at 64, a fast drop at 49. We're seeing bearish moves on this sector. Roblox, we're still seeing a strong sell-off. So apparently, with a decline in user growth, no matter how the revenues are growing, it's not enough for the valuation. It's falling based on its own weight. So the problem here is that what previously was a support of $80 also broke down. With supports breaking down, it's possible any rallies to 84 or 85 will just be sold down, could possibly retest that $67 area. Sentinel-1, as we are seeing IPOs, we are seeing relative weakness here. And so definitely the market could see this fall again all the way to $35 or $40 below. Oatly Group, there is a news by a short seller activist that they are saying that Oatly Group might have inflated revenues And there also is a competition between Oatly Group and the other other milk companies that are also now offering oat milk. So you've got oat milk, almond milk from Quaker Oats, Quaker, the company. So you've got a lot of competition nowadays. It's possible that Oatly could be a commodity with many companies able to participate in the alternative milk craze. And so these drops are getting a lot of short selling action. Two reasons: valuation, competition, and what some short sellers are saying is mind control or greenwashing. Now, you may not believe in that because, of course, Oatly has a lot of partners, in particular Starbucks, and a lot of baristas like using Oatly. However, this unfortunate drop is something that you cannot ignore. IPOs in general at these levels are usually priced to perfection and therefore getting sold off as a consequence. And as most people are saying, they don't want to commit their money to the market right now, but it's very hard to ignore the values on some SPACs. Indeed, some SPACs and some 10x winners are just getting sold left and right. You're seeing Bark, which is like a smaller Chewy. This is an e-commerce for pets. Butterfly Network for medical devices, SoFi, Desktop Metal, Markforged, Palantir getting sold down 50% and more from their peaks. Some people are also thinking about Origin Materials, which is a great biodegradable plastic play. Proterra, because it's the Tesla of buses. So you're seeing in general, SPACs are getting killed left and right. And people are seeing that the market are just having rapids under account C. What you see in the Nasdaq doesn't show you the entire sell-off happening in the entire world. Understand that the VIX right now is very down. The 10-year bond, the treasury bond yields are down. But definitely if inflation is persistent and inflation kicks in and higher interest rates go up, your treasury bonds will actually fall. So you could see that volatility will spike in the next coming weeks. And rotating to safety is actually hiding into cash or even shorting stocks that are overvalued in our view. Many mid-cap stocks are already getting nuked $10 down. And these are like $20 to $10, $15 to $7. Shorts are eating well. Most of my tickers are being nuked. Also like bios. Big tech, yes, they're gaining, but the market looks toppy to me. Nasdaq versus S&P, I see a correction coming, not a bad thing. Even the biotech, man, it feels very ugly. So very few are going up. Thank God for IMMP, huge gain, very little. So you could see that while BIIB went up, right now Biogene is also getting an FDA investigation about how they're approved with their Alzheimer's drug, which was a reason why we sold our BIIB very quickly on Monday. If we didn't sell it last Monday on down 6%, it would have been down 16% as of Thursday. I don't know tonight if it goes down again 10%. And many people, and I'm going to tell you, all traders in the world can see small caps, traders and investors around the world are seeing that small caps are struggling. Money is moving, especially to large caps as a defensive move. Consumer staples like a Procter & Gamble. And consumer staple utilities, real estate doing well. If those are doing well, those are what you call defensive industries. So with lots of losses, people are seeing that market indigestion is creating opportunity. What they're talking about this opportunity is the implication of lower valuations or a reset is possible. When you're saying indigestion and consolidation, they're waiting for a big sell-off in the next coming weeks. This is what's happening with Biogene. Take note, a big pump after the FDA approval and then an investigation about that Alzheimer's drug approval is showing that drop. 460 I wouldn't be surprised if this goes to $280 in the next coming days. And even if Cathy Wood, the perennial perma bull, is buying stocks, take note that July, she's still continuing to buy. She's buying NVK because it's the molecular diagnostic testing space. The problem with being a bull is that the red skies are actually blood. It's not blue skies. We're seeing a bloody red sky. And even for the July and August months, what's coming is actually an average drop for the last 50 years and the last 20 years. The only time August was up as a month was only in the last 100 years. So if we're going to take the recent data, we will see a drop in August and September. So really, it's going to be a tough 2 months coming from now. And S&P, well, it's already showing a drop already, some weakness under the sea. It's calm under the sea. August and September, they cannot hide the truth anymore. We could see a huge negative sell-off. And market correction since the World War II, you'll see an average decline of 13% over 4 months. So if it's going to happen July, August, September, it might end only October. Average, a 10% loss, whether that be S&P 500. This is actually Goldman Sachs. They're showing average. Take note on these drops. Usually it's happening July, August, September. So preparation is key to that movement. Now, of course, the fastest bear market happened during 2020, which was 16 days. The fastest on the record, February 19 till March 13. It fell further. The final drop was March 19 to March 23, 2020, or a month. Still, though, because of the fastest bear market, we also had a fast recovery. It begs the question about today's, and it, of course, had the best gain around March 13 to March 19, when there was a national emergency, which was the trillions being printed. BlackRock CEO Fink is also saying, Larry Fink doesn't see that inflation is transitory. If inflation will persist 4%, 5% for the next 4 to 5 years, number one, cash will not be the safe haven. Indeed, somehow, somewhere, you don't want your cash to become rotten. But at the same time, with inflation persisting, there is a necessity for the Fed to raise rates in the next 4 to 5 years, whether that happens 2022, 2023, that tapering is going to happen. And what people are preparing for is that tapering. And when that happens, this is what's going to happen, a bloodbath of epic proportions. So we are preparing for something like this, even if we don't know if it's going to happen next week, next month, next 2 months, but it's better to be prepared than to just not, right? Now, what happens during bear markets? One strategy is, of course, a cash out all positions, a nuke all approach to wait for that red day like this to happen before buying into the market. So that is a tactical trading strategy. This was recommended during March 15. And in my view, right now, July 15, 4 months after, it's still in that bearish zone. July 16, July 15, that's still an approach that is okay. Buying defensive stocks is what other people are doing. They're buying the FAMDAS, large cap, stable companies. They're buying dividend names because that they believe is going to be able to weather the downturns better than the small caps. And that's why you're seeing Amazon, Apple break out to all-time highs. That's why NVIDIA broke out last 2 months ago. And another strategy, of course, is number 3. You want to go bargain hunting and take advantage of really depressed prices and snap up the fundamentally strong stocks. Because when there is a bear market, there will be companies that will go down 90% down, 80% down from its peak, 70% down. We saw that happen during May. We snapped up those golden opportunities when Agrify was trading at 7, when Arcimoto was trading at 7, when solar firms like SunPower traded at 20, when Palantir traded at 18, when NEO traded at $30+, when XFAB traded at 25. If those things happen, that strategy will give you that 50 to 100% move, which will not happen when you're waiting for your apples to go 50 to 100% up. So these are strategies that are valid. Of course, the maximum intra-year drawdown for the S&P 500 is usually 15%, which we haven't seen yet. We haven't seen yet because everyone is parking their money in the FAMGAS, which is preventing the Nasdaq to fall. Now, other people would buy some puts because they feel a bear market is developing. They're willingly gonna buy a put on the Nasdaq at 15,000 or 16,000, and they'll take a loss if those puts expire. Of course, a long-term put is more beneficial if you don't want the time, because it's very difficult to time that it will fall next week or next month. If you're bearish, you buy a long-term put in the Nasdaq or in the S&P 500 or the QQQs or the SPYs. You buy a put for 2022 or 2023, like some strategists are suggesting. The problem, of course, is that a put option will expire worthless. It means that if I buy $1,000 put, it could just expire to zero. Because if the market continues going higher, the puts will actually be senseless. However, if you think that the Dow Jones, the S&P, and the Nasdaq are very toppish, your puts will gain if the indexes will fall. Because options will increase or decrease by a much larger percentage than stocks. They are leveraged options. You usually think that this strategy is very risky. Therefore, if you're going to do a long-term put or a short-term put option, make it less than 5% of your portfolio. So don't make it too huge. Now, of course, the biggest bull in the market is actually a good short candidate. ARC Innovation, top holdings, the percentage below highs. Tesla's down 28%, Roku down 17%, Teladoc down 53%, Square down 17%, Shopify down 9%, Zoom down 39%, Coinbase down 48%, Twilio down 20%, Spotify down 36%, Unity down 44%. Most of these names are not making enough cash flows and are high growth names, meaning revenue growth is there, but earnings and cash flows are not yet there. In that sense, some people would say Coinbase should fall another 25%, and I won't disagree. So among these Cathy Wood stocks, ARK Invest, of course, a very huge fund. And these are the names that they own a lot of: Tesla, Square, Teladoc, Roku, Shopify. Therefore, if you want to just sell Cathy Wood growth name, and if you think many people will just short ARK K, a simple short on Tesla, Square, Teladoc, Roku, Shopify will already fix that. Just like if you wanted to short Nasdaq, you could just really short an Apple if you dare short Apple. So ARK Innovation here is an easier short because these are not yet cash flow generating. These are the next spam gas, but the problem is they're not yet earning cash. So they're still burning some money sometimes, capex wise. So ARK Innovation ETF is actually toppish here at $130. You're seeing it already fall to 116. It doesn't take a wild guess that it could drop 26% yet again here to about $100. Tesla having a hard time here at $680. Started shorting Tesla, could go to about $600, which is about 15% lower if you started selling 680. So the sellers in January and February of 880 and 900 will continue to pounce on their shorts. The biggest short in Tesla with $500 million worth of short is actually Michael Burry. So far, he is right with the short call, and we have to agree that is a short. Roku can see a strong short candidate here at 480, 440, and even at $400, as even a small drop is still $360 or a 10% downside. We have to agree that these valuations are toppish, and being aggressive in these are not recommended. Teladoc, however, has fallen a lot, and people who said about Teladoc being so valuable, and I would agree, therefore for Teladoc, I would not short it, because at 146, even it falls at 131, my guess is after a 56% drop, it's already oversold. It's in my category 3. Diba? I have category 1, nuke all. Category 2, park in safe, large caps or dividend, consumer staple, strategy basket number 3, buy oversold stocks. Oversold stocks like Teladoc qualifies in that number. Therefore, if you have Teladoc, I'd say hold on to them no matter how much the bleeding can get, because this 50% drop and 60% of Teladoc might actually be too negative already for them. Shopify, however, has leeway to fall. So here at 1.5, I'd say that it can fall to 1.3. Why am I saying that Shopify might not even go down to 1-1? Because super strong growth may actually prevent this stock to fall back to the main areas of 1-1. After spectacular earnings, I feel that 1-3 or 1-1, any drop here is more of a blessing in disguise rather than a problem. I don't really believe that Shopify will really sell as low as 1-1. But that said, at 1-5-1-4, I'd have to agree the people who bought it might actually profit take here at these levels. So the catalyst for a drop on Shopify will just be valuation. It's not about the business model. Zoom video, as you could see, weak already, and therefore a weakness on 394 tells you that this could drop to 350 or 325. However, with Zoom video, I'll also say that you don't need to be too bearish because the $300, in my view, is just going to be a retest. Because Zoom video, no matter how much we think the COVID variant, the Delta variant is here, whatever really happens, people will still be using their Zoom video for their remote work and be a necessary office work collaboration and even for online education. So I do think that the bears will actually not succeed in case Zoom video falls on an oversold region. The only reason the technicals here are selling off is because we found an overbought area 394, but not really a really bad thing. Whenever an overbought condition is getting sold down, it's just a healthy reset. How would it reset? What I want Zoom video to do is actually bounce from 330 to 345, just like what I think Shopify will do, which is a bounce at 1.3. However, if we're talking about today, at 360, of course, it can fall another 10%. Coinbase, no reprieve. You can see that even if Kathy Wood wanted to make a crypto ETF, the market is not willing to front run that ETF anymore. And cryptocurrencies in general are actually on the brink of 30,000, perhaps falling as well and breaking down. And therefore, it's possible that Coinbase breaks this $211. And when that happens, another new low. So Coinbase was expensive to begin with. I couldn't justify the valuation ever since IPO. I'm not really surprised that it's falling massively down. And this will really cripple ARK ETF as well. Their fandom on cryptocurrencies and Coinbase will actually trigger a negative sell wave for ARK Invest on a valuation sense. Square, no matter how great the numbers are, this one I'm less inclined to sell. However, I'd say that this one is just perhaps having a problem at 250. Could have some buying pressure at 210. I'm more in the leeway that thinking that Jack Dorsey Square is more diversified revenue stream. Only 5% of their holdings is Bitcoin, and only a little amount in their revenues is cryptocurrencies. Although they're now introducing more financial services products in Bitcoin, that was just announced today. Square is creating a new business line. I think that's actually helpful for Square rather than negative. So I'm saying that it's toppish, but I'm quite neutral when it comes to Square. Square is building an open developer platform, sole goal of making it easy to create non-custodial, permissionless, decentralized financial services. And because we see millennials and Gen Z, 70% of which are open to opening their crypto wallets, I think that Square is actually a winner, not Coinbase. Cash App, Square Seller Products, the music streaming service Tidal, which they acquired earlier this year. Dorsey has long been interested in transforming Square into a broad organization with a number of standalone units. This could become a bigger entity, offering more financial services products. And with Cash App growing very ferociously, this, I think, is the true crypto winner, if there is a winner. Twilio, of course, you're just seeing a sell-off just because of valuation. They introduced Twilio live last night. But yet, even with good news, you're seeing the market sell it off. That is a typical classic buy the rumor, sell the news. And when you're seeing the market sell a company on good news, that is a bearish take. So everything good news is priced in. We see Twilio just dropping maybe $300 or $320, still 10% downside. Unity, okay, so Unity has been unable to break this earnings problem here since early February to March. And even when earnings here managed to rebound because of only oversold sentiment during May, tell you what, around August, it's gonna be a question mark. If on August Unity is at $80, then therefore it's an easy buy because on earnings front, I do think that $80 Unity is gonna go up. However, if on August Unity stays at $100, people would rather sell Unity at $100 because of any earnings risk. So I think that Unity is in a neutral zone. You're seeing that it's trading at $80 to $100. It's gonna trade in a range. So I'm not really calling for a crash on gaming stocks because gaming, at the end of the day, you've seen Activision, Electronic Arts doing very well. Take-Two doing very well. Revenues are very well as a sector on gaming. Nvidia's growth came from gaming. Tencent growth came from gaming. Well, there are regulatory concerns on Tencent, of course, and a lot of Chinese noise. But for Unity, make it into Unity and Roblox, in my view, are more on just a valuation concern. It has nothing to do with a real problem. Okta, valuation concerns. Almost all your software concerns are just valuation concerns, whether it be Avalara, Shopify, Okta, Zoom. These are just overvaluation concerns. After a drop like me, I'd say this is going to be a buy. So you're just really looking for a retest here. Coupa Software, different scenario, 360 to 80. When you're seeing a 10% drop last night on bad numbers, any rally would retest all the way to 178. So for these names, we see a new low happening, a breakdown of main lows for Coupa. So Coupa could fall further and more than 20% drop on the next few days. DocuSign, good numbers, yes, and that's why from earnings it rallied from 210 to 280. But wouldn't you agree with me that the market is already pricing in the values, expensive valuation, the 280 can drop to 240. The buy the dip crowd will wait to 80. I don't think the buy the dip crowd will also buy 277. So the shorts are in just a perfect risk reward scenario right now. The valuation is toppish. You're at the technical resistance. You are at the double top on DocuSign. Just a perfect storm to ensue. Zscaler, the same thing, perfect storm to ensue. Notice DocuSign and Zscaler, very strong earnings movement. So these are not necessarily bearish. They're just price to perfection. CrowdStrike, just price to perfection. Very good numbers if you listen to the earnings call during June. And that's the reason why during May to June, discontinued extended to new highs, just like what happened to NVIDIA. That's why what I'm saying here is that good numbers like CrowdStrike, Zscaler, DocuSign, they're not bearish forever. In fact, they would qualify in the buy the fucking dip if they dip about 20% lower this coming August or September, if I'm going to make an estimate here. So NVIDIA will have a bottoming out, in my view, August or September. Right now, these sell calls on NVIDIA is just a short-term tactical answer. After a 10% slide, cover all your shorts because it's possible that people will buy them back. AMD, also just a short call right now at 95, would have a lot of buyers at $80. The trade desk, also just valuation concerns. Earnings front, they went up. That's why from $50 rally to $80. Any drops could actually be muted because DocuSign, the trade desk, they had good numbers. Shopify had good numbers. That's why I'm not sure if they will retest the main lows. The trade desk can just have a higher low somewhere here in June. But then again, here at 80, because this is extended, you have a recipe for just a profit-taking move to $60. But that's still 10 to 20% lower. Enphase would have a stronger drop in my view. So the solar sector is weak. Enphase could fall here to about 140 or even 115. So be more careful on the solar names. Enphase has a stronger short in my view. New lows coming for the following names. Hydrofarm, in my view, was very expensive as an IPO. And you could see that nobody wanted it 92 to 49, even at any level at 56, still being shorted, unable to break above March, lower highs even during the rallies on June. So this is a recipe to make new lows. A break of 48 opens up a drop to $40. Big Commerce, also nobody liked it since IPO. You could see 160, 120, even at 60, no buyers. These have leeway to go all the way to $40. bad companies will have bad numbers and bad valuations all the way and expect new lows for them. Workhorse, expect new lows, had a bad number here. They lost UPS as a client. They can't actually rally. This is what you call a short squeeze rally. These are expected to fall to new lows. So $12 can go $8, $6. It's not an impossibility. Funko, it rallied because of the NFT craze, but because Funko will not have good numbers in the next coming months, expect Funko rallies to be shorted in my view. Same thing for Playboy, rallied on the NFT hype, the non-fungible tokens. After a rally from 12 to 60, I think this is an epic short discussion to go down to about $16. Any rallies at $35 was actually muted, rallied to 44, then broken and sold off. So expect new lows for Playboy. Sentinel-1, expect new lows. Actually, for Sentinel-1, it's a great company, but it is very expensive nowadays. And with IPOs expensive, I'd say it can fall from 54 all the way to $40 or even break below and make a new low. Upwork, Upwork, not a new low, but I just think that this drop can be a recipe for a $40 drop, 49 to 40 or 20% drop. Coupang, IPOs selling off, so very expensive on the fresh gates. When it debuted in the market, it was a sucker's rally. And you could see 68 falling down to 32, rally to 46. I think this is still a sucker's rally. Coupang goes down to 35 or 32. I know people like e-commerce, but Coupang's valuation is not meant to be. Now, space is being attacked. All the billionaires, they're saying that space, people, Elon Musk getting attacked, Richard Branson. Unfortunately, people are not really understanding space sector. They find it too expensive. Who's going to go to space? What's the implication of all these GPS software? What's the point of owning Maxar Technologies? What's the point of internet in space like Starlink? Most people don't see the future, unfortunately. And so these are the memes happening in the space stocks. We did it. We gave them hope. But people see a world burning. They see that the valuations and the money flow, which is $20 billion allotted to the space sector, is too frothy for some people. In fact, they think that the existence of space race between Jeff Bezos, Elon Musk, and Richard Branson is just a clear sign that these people are not being taxed enough. And people are saying something like this: commentaries, billionaires rocking off to space is not a sign of progress. It's a sign of grotesque inequality, allowing a select few to leave Earth behind while the rest of humanity is suffering. So some people are saying grotesque inequality is an understatement. They have spare cash. Why don't they just give it to end child hunger? So a lot of space stocks are now what we call bag holders. And bag holders this is the typical bag holder. Space is like buying Amazon in the 1990s. It's a new paradigm. The fundamentals haven't changed. Mommy Kathy is buying more. 3D printing stocks. Just look at Tesla. Short ladder attack. All I can say is that the space stocks and the industry right now is getting a lot of FUD, fear, uncertainty, and doubt. And that's what happened even with the successful move of Richard Branson. Virgin Galactic sold off from $50 all the way to $30. Still unknown support right now. Could it go down to $16? It could. There's a lot of bag holding in the space race. And I'd say that with people calling the bubble, from Jeremy Grantham saying this is the biggest bubble since 1929, housing market, stock market, bond market, it's gonna be the primary trigger and the bullseye for the people who hate the market. The people who hate the market will trigger a short on the space names because that's something that is still a very far off revenue plan. It will never have income for the next 7 years. Therefore, they are an easy short candidate. And some people are saying you better hope Jerome Powell is wrong. Jerome Powell is saying that inflation is transitory because the implications are far more serious than most realize. If despite trillions of dollars of stimulus that inflation is indeed transitory, that would suggest no amount of money printing is counter to deflation debt bomb that the Fed has just created. I don't know what this deflation debt bomb they're saying, but they're saying nuclear deflation debt bomb will create a financial Armageddon. It's something deflation that happened in Japan 1990s, I think. So a lot of people are saying that selling will accelerate. And I took a look on the Chinese stocks as well. Now, you will assume Chinese stocks after a 30-40% sell-off from their 52-week highs are already a bargain, except that with regulatory concerns still hounding, it's possible that they would continue to go 50, 70, 60, 80% further. So look at this. Ganfeng Lithium is the main candidate that will that is a commodity that got saved because some people are buying lithium, nickel because of electric vehicle shortage. Just like the same chip shortage, there's a real demand out there. However, you are seeing that overall, almost all of your Chinese stocks are valuable and oversold, but oversold can continue to be oversold. There's no problem when it comes to BYD, especially if they're working batteries with Apple cars. But Tencent doing well in their gaming doesn't preclude the fact that Chinese just passed on an artificial intelligence from 10 p.m. to 8 a.m. preventing kids to actually play games, which will, of course, cripple some of their gaming, which is 50% of their revenues. You're noticing JD Belly still 30% down, Alibaba still 30% down, Futu 30% down, Neo 30% down, Razer 38% down. The fact that these are 30% down does not stop them from becoming 40 or 50% down. In the first place, the fact that they are just 30% down is already a relative strength in the sector. Because Alibaba, Futu are growing like 100% in their respective cloud computing spaces, brokerage firm spaces. Now, why is there a huge drop? Because, and of course, we know Neo is better than Xpeng. So Neo is 35%, Xpeng is 50% drop, bigger drop for Xpeng because it has no battery swap stations yet. It's less diversified rather than the Neo ecosystem. Nonetheless, you're seeing really that the smaller company, example like Pintuoto, 48% drop. I would like to assume that there is asymmetric upside in Chinese stocks, but with the ongoing dilemma that China's political party is doing, there's really hesitation. Some people are really scared that even after a 30 to 50% drop in the fundamental valuation versus 50 to 100% growth on these names. So we're talking about price earnings growth, really like super cheap. That said, the market still is unwilling. If people are still unwilling to bargain hunt names like Douyu down 80%, Ihang down 77%, Agora down 70%, what should an awesome 10x investor do? If you've got any of these Chinese names, example, you own Douyu, don't sell it. These 80% drops, in my view, are going to be the bargain hunting centers when we see a potential low in the market. It will bottom out. So I think at the very least at 4.8, after a rally to about, of course, there will be resistances. But then again, what we saw in Ihang last time, when Ihang went from 20 to 47, it could happen with Ihang again, 30 to 40 plus. Though you can go $4, $5 to about $6, $7 yet again. Agora at 35, don't prevent it from going to 45. These battered names have been battered so much that I think there's no amount of bad news that can kill them down. They're already in the basement 4 or basement 5. So it's better to just hold them than sell them. Now, for Chinese education names, we know why Edu, Tal, and Kulearn are falling. It's because the Chinese State of the Nation address said that all the online education names can never increase their selling price, the average selling price, because the government wants education for all to be cheap and affordable for everyone. You cannot be rich that you can afford better tutoring services. So in that view, the online education space got pummeled down with a real Beijing crackdown. All of these dropped because of a real regulatory concern. Though you dropped 80%, why? Because China prevented Tencent to merge Douyu and Huya. If that merger were happening today, that would not trade at $4.80. So sometimes I think about these regulatory concerns as an opportunity to think about the future. Because at the end of the day, the reason why JD is buying Dada and why Walmart is buying Dada at $22 is because they see value. At the end of the day, ask yourself, would a drop of 60% be a bad thing if the company is really growing their e-commerce sales very well? Because JD is growing 50 to 100%. They just reached 500 million users and they're hitting trillions of yuan in sales. UP Fintech, which is growing more than 300% in their retail brokerage firm, is trading at an undemanding 50% valuation today. So the truth is, the fundamentalists such as Charlie Munger is buying a lot of Chinese stocks. Even George Soros is buying a lot of all of the fundamentalists in the world cannot deny the value in Chinese stocks. So I wouldn't short these names. These are what I call basement number 3 or basement number 4 or basement number 5 types of stocks. I'm not saying that they won't fall. They could remain down. And even Kathy Wood said these stocks could have a valuation reset, but it's already reset. How much lower can it fall? I'm not saying that they won't fall, but I think that to sell them at these levels is not the right way. Kathy selling Chinese stocks is not the Kathy Wood I know. That's not how a permable thinks. However, even if all you do is survive, that's good enough. In a market crash, getting defensive, buying some puts is one way to limit your downside losses. What am I doing? I'm shorting. Yes, I'm short the Nasdaq. At 14,900 or 15,000, I'll short the Nasdaq. That is a bearish way to handle the market. I can also short $35,000 Dow Jones, can also short 4,400 S&P 500. That's one way of getting defensive. However, keep an eye out for oversold values, buying shares of great companies when they're on sale and at a deep discount. I'm not selling my Pintuatuas or Alibabas just yet, still too low. I'm not selling Agora or Doyu, they're very low. Whether it's a small size or a large size, fortunes are really made in crashes. You can actually make money because in US, there's always deep value alpha. This is one of the reasons why EHang went from $20 to $47 in a single month. Did you see Arcimoto? It went from $7 to as high as $17 in just 30 to 45 days. That's what we call deep value alpha. We call that low. We called the lows on them because we never saw a real fundamental reason for EHang to fall to $20, 80% down. So for these stocks to fall 80% down yet again, it's just going to be values, guys. And I hope you understand, crashes are just transitory, especially if the companies you're buying is a real leader. It will not stay down forever. That's why you have to trust in asset allocation. Having an appropriate asset allocation is the key to reducing investment risk. Ask yourself, do I have cash in case next month, Nikki is predicting maybe the market has a chance to fall 10 to 20% next month. Let's say DocuSign fell 20% and you want to own a leader. Let's say CrowdStrike fell 20% next week or 2 weeks from now. You want to buy those leaders. What if NVIDIA fell 10% next week? What if Tesla fell 10% next week? You want to have cash to buy those dips. And therefore, if you do not have cash, you have to diversify to reduce your investment risk right now. You might have to plan during downtimes. In this case, it's best to sit tight, trust that your portfolio is ready to ride out the storm. If there's downside of 10 to 20% or 30% or new lows coming, if you have the companies that I said have a potential new low, be careful on those names. So example, for Fastly, I exited because it could go new lows. Affirm, I exited, could go new lows. Now, you want to focus on the long term. When the stock market declines, it's going to be difficult to watch. Your portfolio's value will shrink in real time. And if you're not doing anything about it, it's sometimes also the best course. Doing nothing is the best course if you're going to buy and cost average over time. A lot of Americans actually who bailed out in the sell-off, in the Great Recessions, actually lost a lot of money because they didn't know how to buy back in. The problem with selling and nuking and not buying back in is very huge. If you will nuke, if you will do the strategy number 1, which is nuke, be very careful because you have to buy the next 2 weeks or 2 months of declines. Because if you don't buy that, you will also be more wrong. You will be more wrong because long term, really, the stocks will go up. Exponential growth, don't forget about these. These are the real growth items happening for the next 10 years. We've got technological unemployment that could be a problem in the future, the changing notion of work, the rise of freelance economy. You're gonna have you have these exponential problems, climate change, and therefore you've got these things happening. Smart grid, connected cars, smart homes, artificial narrow intelligence, smart cities, connected healthcare, next-gen education, sharing economy, automation of everything, cyber war, autonomous vehicles, healthy life extension, energy internet, maker economy, maker money 2.0, circular economy, artificial general intelligence. These are really happening. And these are the ones that are still early times. Early times, 3D printing. Some people are still saying renewable energy is early times, although we don't think it's so. Internet of Things, nanotechnology, robotics, blockchain, genomics, drones. The reason why the short people love to short genomics like Envita or BIIB or Intelia, and the reason why it's fine to short them is because they're highly expensive, and you know that is, and the numbers will only come 5 to 7 years from now. The waves of innovation is indeed there. We're in the sixth wave right now. We're in the stage of biotechnology and software information technology. And for the people who want to just avoid selling, nuking their stocks, you could just use a strategy of dollar cost averaging. This will help you avoid buying a position at the peak or selling at the bottom. If the markets bottom out next week, you have to think about it as, oh, it's a great opportunity. I'm going to invest for what matters to me. Take note on the stats. Between 1928 to 2016 until 2021, the S&P actually averaged just 10%. So in any given decade, of course, stocks can and do crash. But if you invest $10,000 a year and earn an average of 10% annually, you'll already have at least $3 million in 35 years by the age of 65, from 30 to 65. So in contrast, if you're investing in bonds, owning just 2% average, that $10,000 per year will just become $250,000 in your bond portfolio. So really a sharp difference. Investing 100% of your money in stocks, you'll come out ahead by $1.1 million, 2.7 versus 1.6 million. Assuming you did 50% bonds and 50% stocks, you'll just have 1.6 versus 2.7. So stocks is still the way to go. I don't believe in people saying that a market crash, it means that you have to hide in cash. Okay, so what companies would you recommend for category 2? The category 2, which is large caps, are usually the big caps. So your PayPal's, what would happen in your PayPal is if $300 is a peak, it will always have a buyer here at 270 and 250. That is a category 2. These are large caps. Your Squares are large caps. Your Tesla is a large cap. In general, if Tesla falls to about $600, that's a category 2. Some people will still think that that is a safe large cap to park. Of course, some people will always buy Coca-Colas. The fact that it's going up and breaking out is a sign of consumer staple defensiveness. So this is actually a flight to safety, or I'd say people are so scared of financial Armageddon that they're buying up these names. Coca-Cola and Pepsi is really the type that look at that, that's breaking out. Visa is breaking out. The reason why that's breaking out is that people are so scared of the market selling off. So the fact that this is breaking out tells me that the market is very, very scared. Yes, Kraft Heinz is something like that because these are really just consumer staples. Indeed, if Kraft Heinz does fall to about $36, yeah, that could be a buy. Wait it out. If the market falls, time it in the sense that if S&P 500 gives you a drop, so let me show to you the SPY. The S&P 500 is trading at 44. There has been corrections even during March and April. Take note, February to March, there was this 6% drop for S&P and then continued higher. So I'd say that your S&P could drop about 5% So from 4.4 to about 4.2, try to see whether you can buy the usuals. People, of course, buy apples if they drop. So meaning Apple, if they drop about 5% from 148 to about $140, cover it already, people will, of course, buy it again. They'll buy 140 or 138 all the way to 160 to 170. That's what's gonna happen with people running to safety for Amazon. They're trying to buy Amazon at 3.5 and 3.6. The reason why they're buying Amazon is not because they think that cloud computing or e-commerce is great. They're buying it because they don't want cash, but they want something safe. That's the reason why. And you can clearly see that the market is buying utility names. When you talk about utility, it's a company like AT&T, like $28. And of course, yeah. So utility is XLU. So it's breaking out. So I'm not quite familiar with utilities. I just know mostly ETFs, but it's very clear that the market is parking safely in these types of names: utilities, large cap defensives, consumer staples. Consumer staple is what's the ETF for consumer staple? XLP. So that is hitting all-time highs. So when these are trading at these types of movements, so if you're very scared, you could have a cash position and just trying to buy XLPs, XLUs. Yeah, it's kind of boring, honestly speaking, but that's what's happening. Me personally, if you're very bearish the market anyway, just focus on shorting growth stocks. Just short Roku, right? I'd rather short Roku. I'd rather short the Trade Desk, Nvidia, Twilio, right? The ones that I shared a while ago. It's me personally, how I'll trade the market is I won't buy the utilities or the staples or the large cap defensives, although I know some people will do that. What I will just do is I would try to buy the category 3, which is the super oversold names when they happen. So I'll buy perhaps EHang if it happens to go down to $20. I'll buy Arcimoto if that repeated again. And that would be my plan. I'll buy some bombed out names, whatever the bombed out name will be, whatever happens in the next 2 months. Now, I do think that bombed out names like Doyu is already there, no need to sell. I also would say that those who have Ashford, it's already here at about $2, no need to sell it because it's already bombed out. When a company is already bombed out 80% down, or in this case, how was this? Like 90% down, there's no leeway to actually be scared. Take note that Ashford was a company that used to trade as high as $100. So this like 99% down. You cannot actually scare me at all. At $2, I think I could really sell it at 3 or 4. So I don't care whatever your costs are. At these levels, I'm looking at the long-term picture here. I think that I have a value play here. And even the Chinese stocks, okay, I like Futu. Let's assume Futu and Tiger gets going down here to about $100 or $120. I think those are buying opportunities. So the people who are very scared on Roblox, actually, I'd buy it at $66. I'd rather buy the growth names on a depressed move. If I could buy it just like the meat prices, I will. So that would be my strategy here. Okay, so thank you guys. I know it's been late. Thanks for listening. Night, night.